And now this brings us to the end of the opening session for the G20 Global Financial Stability Conference 2021. Thank you very much for watching this keynote speech, all of you. Thank you very much once again. And as societal change accelerates due to the convergence between each industry, it has become an important time to think about how these phenomena will affect the global economy. So after setting up the stage, we'll just continue to the session 2 of today's conference. So actually, before we start and during the setting up the stage, I'd like to introduce today's G20 Global Financial Stability Conference. And this conference is meeting its seventh anniversary this year since its opening in 2013. It has played a role as the forum of discussion for scholars and experts in the field of world economics and international finance to examine dangerous factors of the world economy and explore its countermeasures. So now, ladies and gentlemen, it is time to start the session 2 for G20 Global Financial Stability Conference 2021. I hope online and offline participants will just participate in this session as well. And now the first session holding various discussions regarding the global financial stability risks and policy coordination in the pandemic era. And during the session, we'll share your opinions and questions if you leave them in the link located in the bottom of the YouTube channel. Then let me introduce the moderator of the second session, the Professor Dongchul Cho from KDI School of Public Policy and Management. Please proceed with the session on stage. Let us welcome the moderator with a big round of applause.
Okay. Thank you, Ms. Moon, for introducing me. I'm Dongchul Cho, professor at the KDI School of Public Policy and Management. I'm going to be your moderator of the first session. It is a little bit awkward sitting here all by myself on this big stage. But I'm not that lonely because we are connected with the 5 globally renowned economists online. Let me introduce them very briefly. First is Dr. Ayhan Kose. He is working for the World Bank as director of prospects group in the equitable growth finance and the institutions practice group of the World Bank. And he's actually leading the bank's work on global macroeconomic outlook. So he's a perfect person for our first session. And second speaker is Professor Brunnermeier. He's a professor at the Princeton University. His research areas cover asset prices, expectations, market efficiency, and bubbles. So he's also is expected to give us great insight for today. And we also have 3 panelists. First is Dr. Markus Bassetto, who is a monetary advisor at the Federal Reserve Bank of Minneapolis. And he also worked at the Federal Reserve Bank of Chicago. His research areas range from forward guidance, inflation, interest rate, almost everything about the monetary policy. So he's going to give us his insight about the US monetary policy as well as other countries. And second panelist is Dr. Tobias Adrian. He's a financial counselor at the International Monetary Fund. he served as a senior vice president at the Federal Reserve Bank of New York as well. And last but not the least is Professor Viral Acharya. He's a professor at the New York University Stern School of Business. And he's an academic advisor to the Federal Reserve Bank of New York and Philadelphia. He also served as a deputy governor at the Reserve Bank of India until 2019. So he's not only the academician, he also served as a monetary policy maker. So I expect a lot of good insights from him as well. Okay. I would like to say thank you all for being with us. And looking at your faces, I kind of envy you for not wearing masks. I wish I could show you my handsome face without my mask, but I should keep wearing the mask here in Korea. I'm sorry for that. But the most important task given to the moderator is to keep time. So I will give 20 minutes each for 2 speakers, 10 minutes for 3 panelists, and last 10 minutes is going to be given to Q&A session. Okay, and as for 2 speakers, if you spend less than 20 minutes for your presentation, then I'm going to return you your saved time after the panelist discussions for you to respond them. Okay, that's it. And I'm going to invite the first speaker, Dr. Kose. He's going to set the floor for the following sessions of the conference by overviewing the landscape of the global economy after the pandemic recession. So please, Dr. Kose.
Thank you, Dongchul. It's great to join this conference. Let me thank Minister of Economy and Finance and the KDI for inviting me and giving me an opportunity to express the views of the World Bank. Quickly share the screen here. I hope you can see my screen now.
Yes, we can see.
Okay, excellent, thank you. So I do hope that we will meet in person, get together sooner than later without a mask, and we can see your handsome face, Dongchul. I'm going to talk about growth prospects after the pandemic global recession today. It's very nice to follow Jeff's presentation. Jeff covered some of the issues I would like to emphasize, so it's going to be an easy ride. I'm going to focus on 3 questions. The first one, what are near-term growth prospects? We are expecting strong growth rebound in the near term, especially in advanced economies. Globally, we will see record growth this year, despite what we have been hearing in recent weeks in terms of activity indicators. But the strong recovery is going to be uneven. Most emerging market developing economies are going to lag behind. I'm going to put this recovery in historical context, and I'm going to explain what this unevenness really means. As much as we have this strong recovery, at least for 2021, risks are quite formidable. Jeff already talked about some of them, and they are tilted to the downside. Next, I'm going to ask the following question. What are long-term growth prospects after this pandemic global recession? Even before the pandemic, we were expecting potential growth to decline in 2020s relative to 2010s. Now, our calculations suggest that we will see a more pronounced growth slowdown over the 2020s, and this slowdown is going to follow multi-year reversal of income gains in many emerging market developing economies. So we had a growth problem prior to the pandemic, and that problem is going to be compounded in the coming years in all likelihood. The third question I'm going to ask, against this basically subdued background, what are policy priorities? And there, of course, it starts with controlling the pandemic, but global policy coordination is going to be essential, whatever policies we are thinking of, especially some of these policies touching on the issues like financial stability, issues like climate-related challenges, and the broader challenges of tensions we see in many parts of the world. Throughout this presentation, I'm going to use this acronym, EMDs, that refers to emerging market and developing economies. Let me start with the first question. What are near-term growth prospects? Now, when you think about what happened in the global economy, since 1960, global economy experienced 5 global recessions. 1975, 82, 91, 2009, and the last one last year, 2020, pandemic global recession. In each of these episodes, per capita global GDP declined. Following these episodes, you saw a rebound. And that rebound, most of the time, proportional to the decline global economy experienced during the recession. For example, in 2009, global per capita GDP contracted by 2.7%, and in 2010, it rebounded by about 3.2%. After declining 4.5% last year, we are expecting global per capita GDP to increase by about 4.6% in 2021. This is going to be the strongest recovery over the past almost 80 years global economy is going to experience. So at the global level, there is this record-breaking pace we see in growth for this year. But when you look at the performance of advanced economies and emerging market developing economies, the pictures are quite different. On the left, you see these gray shaded areas, how the advanced economies perform following a global recession. You see our 2020 baseline and 2 scenarios we focused on, a sustained expansion and faltering recovery. Sustained expansion, basically you control the pandemic quickly, you don't have financial stability problems, and you normalize your policies gradually. Faltering recovery could be associated with basically COVID-19 outbreaks. We have seen some of those already. And then some type of financial stability challenges. I'm just summarizing these scenarios simply. Now, as you can see, advanced economies are going to basically deliver strong growth this year, in all likelihood, if they are able to control the pandemic and then, in a sense, control some of these risks associated with inflation-related challenges and the financial stability challenges, and continue to basically deliver growth. And that puts them in a recovery path better than what we saw in previous global recoveries following recessions. In the case of emerging market developed economies, though, the story is different. These economies are going to have somewhat lackluster, basically recovery in comparison with the previous episodes. And if the recovery falters, growth outcome could be much weaker. So advanced economies, in fact, are going to recover twice faster than what they did in 2009. And emerging market developed economies are going to probably recover 1/5 slower than what we observed during the basically 2009, the recovery following the 2009 episode. What do these mean when we think about basically state of these economies into two to 3 years' time. In the past, when you had a global recession, about 75% of these economies, more or less, went back to their pre-recession peaks after 2 years. Whether you look at advanced economies or emerging market developing economies, that share was around 75%, as you see on the left chart. During this pandemic recovery, we are expecting advanced economies to do something they have never done before. 90% of them are going to go back to pre-recession peak after 2 years. In the case of emerging market developing economies, only 1/3 of them are going to go back to their pre-recession peaks after 2 years. What's the reason for these unevenness? One important reason, of course, the pace of vaccination. As you can see in the middle panel, relative to our January forecast, when we came to the June, we upgraded our forecast in those economies. They made significant improvement in vaccinating their societies and downgraded our forecast in those countries. They lag behind when it comes to basically vaccinating their society. Now, Jeff already mentioned this unequal distribution of vaccines around the world. And when you look at the recent COVID-19 outbreaks, these outbreaks focused on in emerging market developed economies. Unfortunately, they didn't basically have the amount of vaccines necessary to distribute their populations. Now, Jeff talked about this issue, and it is going to be a critical issue going forward, of convergence. Convergence has been a challenge during the 2010s. You see on the left chart, the growth differential between different groups of emerging market developing economies and advanced economies. So here I have LICs, low-income countries, FCS, fragile conflict situations, small states, and the IDA countries. These are the members of International Development Association, low-income countries and lower middle-income countries. As you can see, these economies did not perform much better than advanced economies during the 2010s. Now, when you look at what they are likely going to deliver in terms of growth over the period 2021-23, in fact, they are not going to converge to advanced economies, as their per capita income growth are going to be smaller than advanced economies. They are going to diverge. When you look at low-income countries, that divergence is going to be around 2 percentage points. If you look at fragile conflict states, that divergence is going to be around 4 percentage points. Now, one important point to remember here, 40% of world's extreme poor live in low-income countries, and another 15% of the world's poor, non-low-income country, fragile conflict states. You can also look at the different regions of the world. I have here East Asia Pacific, South Asia, Europe, Central Asia, Latin America, Caribbean, Middle East, North Africa, and Sub-Saharan Africa. And you look at those and you see that we have a huge challenge in terms of catch-up in Latin America, Caribbean, Middle East, North Africa, and Sub-Saharan Africa. And the challenge was there prior to the pandemic. It's going to be with us during the next 3 years. There are significant risks in the near term. One of them is, of course, COVID-19 flare-ups, vaccine rollout delays in emerging market developing economies. Another risk is related to financial market stress. Many of the speakers are going to discuss that issue today. That could be triggered by elevated public-private debt levels, inflation expectations becoming the anchor, or corporate defaults. Geopolitical risks are critical, and there are climate-related risks. One important risk is that whatever long-term growth expectations we have, those expectations might be disappointing. So in the second question, I'm going to look at these long-term growth prospects after the pandemic. Now, there are different ways of thinking about the long-term growth prospects. One important way to think about it, how large were the output losses during the pandemic? Here you see on the left, we have the basically global output path over the next 5 years and our baseline and downside scenarios. Even by 2025, global output is likely is still 3% below the pre-pandemic trend. And if downside risk materializes, it's going to be 4%. And cumulatively, over the next 5 years, output losses will amount to around 40% of pre-pandemic GDP in emerging market developing economies. So when you think about growth prospects and stick to the baseline, we will, in all likelihood, never recoup the losses we had because of the pandemic. When we think about future growth prospects, there are two metrics we can use. One is potential growth. And we know that already over the past decade, all fundamental drivers of growth, investment, productivity growth, improvements in education and health, working age population growth had slowed. These trends were expected to continue over the 2020s. Last year, investment collapsed in emerging market developing economies, as well as in advanced economies. There were severe disruptions to labor markets. In fact, global unemployment rate increased significantly. And as we all know, education systems were subject to substantial disruptions. Around the world, more than 90% of school-age children were unable to have the type of education they used to have for an extended period of time. Because of these disruptions, we are now expecting this potential growth slowdown we calculated prior to the pandemic to be even deeper. Over the past decade, growth averaged around 5%. Prior to the pandemic, we thought potential growth in emerging market developing economies was going to be around 4%. Because of these disruptions, we think that now that number is going to be 3.4%. Now, another way of thinking about these long-term growth prospects is to basically look at forecasters' expectations about long-term growth. You might think that potential growth is a difficult concept to handle. These are the basic growth expectations of professional forecasters coming from the consensus. And when you look at those numbers, you see that the growth expectations have been declining at the global level. For example, in 2010, 10-year ahead growth forecast was around 3.5%. Now that number declined to 2.5%. So over a decade, we reduced our 10-year ahead growth expectation at the global level 1 percentage point. Now, for advanced economies, of course, because of the headwinds associated with demographic changes, productivity slowdown, and investment slowdown, growth expectations have been declining. In the case of emerging market developing economies, these expectations increased during 2000. But now, since the beginning of 2010, expectations have been coming down and coming down significantly. In 2010, consensus growth forecast 10 years ahead was higher than 6% for emerging market developing economies. That number is now around 4%. So one thing we know about these growth expectations, they tend to be optimistic. So if you take out this optimism bias, we all of us together will see, in all likelihood, lower than 4% growth in 10 years' time. Let me turn to the final question. What are policy priorities? And here, the first policy priority is basically ending the pandemic. That requires accelerating the vaccine distribution and deployment. And coordinating policies globally is going to be critical. Macro policies have to balance, on the one hand, support the recovery, on the other hand, preserve the price stability and fiscal sustainability, as well as financial stability. This is not easy. Policymakers need to basically be careful when they withdraw the accommodative policies, but at the same time, these accommodative policies have to come to an end sooner or later. That has to happen in a gradual fashion. Advanced economy policymakers need to be very clear in their communication, especially central bankers, when they basically think about monetary policy because of the reasons Jeff mentioned. And finally, we need to undertake reforms for a green, resilient, and inclusive development. Basically, bringing things back to in a better shape. That will involve reducing trade costs, encouraging worker allocation, given the transformation we are seeing, making sure that we basically recover the education losses by raising human capital, increasing digital connectivity, addressing informality, because sooner or later we have to basically address fiscal challenges, and spurring green investment. Let me briefly talk about the debt challenges. Last year, we saw a record increase in debt. At the global level, government debt to GDP came close to 100%, increasing by about 14 percentage points. Emerging market developing economies registered an increase in debt. The last time basically that increased that much was in the late 1980s, and we saw multiple financial crises in these economies. Now, going forward, when you look at the debt forecasts from international organizations as well as private sector, these forecasts tend to be quite optimistic. Global economy never turned things around and had a period of stable debt ratios after a major global recession. In all likelihood, governments have to continue issuing debt, so they need to find a way to address this challenge. In low-income countries, this challenge even higher, as we are trying to address now in the common framework. Another important challenge is related to climate-related risks. There is definitely need for great investment. And over the next decade, we will see a major transition when it comes to energy, how we produce energy, how we consume energy. Commodity exporting economies will face significant challenges if they're relying on the types of, fossil fuel producing energy, and those that are producing the types of raw materials for batteries will have large growth dividends. How this is going to be managed, critical. And of course, the infrastructure investment is going to be critical to make sure the mitigation and adaptation policies are going to be there to help the most exposed economies, given a very large share of the poor live in basically places very vulnerable to climate-related risks. Finally, one quick word about the reforms. Reforms do pay off. In our latest Global Economic Prospects report, we undertook this exercise, looking at what happens if every emerging market developing economy repeat its best 10-year investment growth, best secondary school improvement, and raise female labor force participation. If that happens, potential growth still slows down, but it slows down from 5 to 4.3% rather than 5 to 3.4% from 2010s to 2020s. And long-term growth prospects improve when countries undertake reforms that improve investment profiles, that improve bureaucratic quality, that control corruption, and improves overall law and order. Let me conclude. I focused on 3 questions today. Number one, what are near-term growth prospects? Global economy will deliver strong growth this year, but that strong growth will be unequally distributed between advanced economies and emerging market developing economies. Single important driver of that is the unequal distribution of vaccines. There are formidable risks down the road, confronting both advanced economies and emerging economies. Second, what are near long-term growth prospects after the pandemic? In all likelihood, we will see a deeper growth slowdown and bigger growth disappointments. The third point is that what are policy priorities? There are policy priorities that basically need to address these short-term challenges, and that starts with equal distribution of vaccines. And there are many reform initiatives at the national level and the global level. It's going to be critical, G20, to take the lead and push the envelope when it comes to reform. Let me stop there. Thank you.
Thank you very much, Dr. Kose, for your excellent presentation. One of the evident characteristics of this pandemic recession is it hits developing countries more severely than the developed or advanced countries. And those emerging or developing countries are known to be more vulnerable to international capital flows as well. So our next speaker, Professor Markus Brunnermeier, is going to share his idea with us, more specifically a conceptual framework that can be applied to better understand the capital flows of emerging markets. This topic is gathering more and more attention from policymakers as well as financial investors as the US Fed's tapering is expected to come up. So now let me invite our second speaker, Professor Brunnermeier. Floor is yours, or screen is yours.
Thank you. It's a great honor and a pleasure to be with you. And I thank the Minister of Finance and also the President of KD for giving me this opportunity to talk about monetary policy spillovers, capital flows, and safe assets. And it will naturally connect very well with the two previous speakers. I just will give a more theoretical underpinning and give it a very much from a safe asset perspective based on some work I did with Sebastian Merck and Yuli Sannikov, and also something which I recently published in a book on the resilient society. So the term resilience came already up in both previous speakers and also in the minister's remarks. And I will come back to the resilience concept as well, very briefly. Now, what was really characteristics for any huge crisis is that you have always huge capital outflows from the emerging markets economies during a financial crisis. And that same thing happened also in March 2020. There were record outflows, and actually they were way larger than during the taper tantrum, which you see in this pink line here. And the COVID crisis, you see the green line of the capital outflows, was also larger, way larger than compared to the global financial crisis, where we argued, as we have seen before, that the emerging economies did better than the advanced economies, and also during the China scare. But, as was seen before, this was actually undone, and actually capital was flowing back because the Fed was cutting the interest rates, and there were quite some measures which actually helped to stabilize the economy. And now it was possible for the emerging economies to stabilize the situation. You can see another picture here. I don't have time to it. You see whenever the crisis, you have this large capital outflows, and you see that in March 2020, it was just extraordinarily large. So the way I would like to think about this is by giving you a safe asset perspective on this way of thinking. And if you think about assets and, government bonds are particular assets, you can think of what you get from assets is future cash flows. The government is paying back some cash flows, but by holding an asset, you also get the service flow. And the convenience yield is part of this service flow. And how much of cash flow you get and how much service flow you get. So if an asset gives a lot of service flow, then actually it doesn't have to give so much of convenience yield. So for example, if an asset is it doesn't have to give so much cash flow, sorry. For example, if an asset is a very good collateral, then like the US Treasury or the German bond, then it doesn't give so much of real cash flow because you get the service flow already. And the emphasis I would like to take here is on the safe asset component. So what's a safe asset? A safe asset is like a good friend. It's around when you need it. So when you have idiosyncratic shocks, your car breaks down, your washing machine breaks down, you have the safe asset, you can sell it, and you can fix your car and so forth. So whenever there are some shocks, you have a safe asset you can build on. For example, you save a shock, you become unemployed. And what's happened typically in times of crisis, in times of recessions, is the idiosyncratic shocks, which you cannot insure otherwise, are going up. So the service flow becomes even more valuable in times of crisis. And that's the nice feature of a safe asset. You don't have to have a high interest rate or any payoffs because you get this nice service flow. Of course, money is a particular safe asset because it gives you also some benefit from relaxing some double or coincidence of wants problems. But let me focus today on the safe asset component. So what happens as the more and more idiosyncratic risk is floating around in the economy, people save for precautionary reasons and they hold the safe asset, and that pushes the risk-free interest rate down, and it can push it down below the growth rate. And if the growth rate is higher than the return on the safe asset, then some bubbles can emerge. And that's related to what Jeff Frankel was mentioning before, bubbles everywhere. Here it's just a focus on the bubble on the government bond. And they can issue, because the government bond, the local government bond, but also the US Treasury serves as a safe asset, and the safe asset component pushes a real interest rate down below the growth rate of the economy potentially. And that allows you for bubbles to emerge, and the government can then play a so-called Ponzi scheme. It can roll over. The economy grows at the rate of G, but the interest rate is only growing at the rate R. So you can just roll over the debt, and actually in real terms, it's declining in value over time. And so I would like to understand the safe asset aspects a little bit better and how it differs between emerging economies and advanced economies. So if I look at this R, so here there was an R in the previous slide without a superscript. This was just the interest rate you have to pay on the government bond. But what is it really? The interest rate you have to pay on the bond is the true risk-free asset interest rate. Then you get the safe asset privilege on that. And you have to pay a risk premium. There's a risk premium. You might lose the safe asset status. And if it's risky that the safe asset status may go away, you have to actually compensate the investors for that. And that's for this, there's a risk premium on it. And as long as the whole component, which is the total R, all three components together, is smaller than G, you can run this Ponzi scheme I was mentioning before. But there's a big difference in what happens for advanced economies. Whenever you go in a crisis, then actually the interest rate is going down. So you have actually a flight into safety, the interest rate is going down, and that means the risk premium is actually negative for advanced economies because it has a nice covariance structure in a sense that it has a nice feature whenever there's a crisis, the US Treasury gains in value. That's a very nice feature to have. That gives you this negative risk premium, makes it much easier to satisfy this R smaller than G. On the other hand, for emerging and developing economies, you don't have this nice feature. It's actually, they might lose in value in times of crisis because it's not a flight to safety into this, and that risk premium is actually positive, and that it makes it much harder to satisfy this inequality. And that's essentially what's driving also to many, what the previous speakers also said, what is why there's bubbles everywhere right now because of this low interest rate, and why it is particularly pronounced in certain countries, and why it might go away in emerging economies. Now, the problem is for emerging economies is there's an additional challenge that your own national bond is competing with the US Treasury for the global safe asset. And if the US were to raise the interest rate, then actually it might create troubles on its own. And in particular, if the US is not raising the interest rate in the short future, but has to raise it more dramatically in the interim future, then it would be more dangerous down the road for the emerging economies. So if the US was increasing the interest rate a little bit now, it probably is fine for the emerging economies. But if the US waits and waits and has to then hike the interest rates more dramatically, These are the two policies might be optimal for the US perspective, but it might not be optimal from an emerging markets perspective. Now, what happens for the emerging markets economy? So I said already, the safe asset privilege is actually smaller. That's why I used a smaller font size here. And the risk premium is higher. So it makes it much harder to satisfy this first equation, the first inequality. But the emerging economy is actually sandwiched. Not only does they have the R be smaller than G, R existing of the risk-free rate, minus the safe asset privilege, plus the risk premium has to be smaller than G, but the R also has to be larger than the dollar interest rate. And if the US hikes the interest rate, then it is actually the case that you lose the value, the possibility to have your own R smaller than G, Ponzi scheme and all this. And that's actually what destroys it. And there's some risk involved. And even if you have this possibility right now, it might go away. And because this Ponzi scheme or this bubble thing might burst, and that actually makes it very difficult. And there's essentially two layers of multiple equilibria here, which on the one hand, you always have, if you issue short-term government bonds, you have to roll them over. There's a rollover risk associated with that. That's already one layer of multiple equilibria, Diamond Dippic and other Calvo, Obstfeld, and so forth. But there's another multiple equilibrium is that you have a good equilibrium where you can run this Ponzi scheme or this bubble and mine this bubble, but you might lose the safe asset when the bubble is bursting. Okay, so there are two layers of multiple equilibria, and you can lose this very quickly. In particular, you lose it when you jump in this bad equilibrium when the US is hiking the interest rate. So this framework gives you a way to think about it, what policymakers talk all the time. How is it the case that suddenly there's a huge sudden stop and capital is flowing out, is moving in the opposite direction? Let me go a little bit more explicitly how this whole thing will play out in a very stylized toy economy, where I look at the US monetary spillovers, but you can also think of risk-off, risk-on shifts as well. So both would work in similar fashions. So, and I consider a small open economy without capital controls, and the US Treasury is the global competing safe asset. It competes with the local safe asset, the local government bond, let's say. So in the initial phase, you will have a high dollar rate before COVID crisis, relatively high. And then I go to a low interest rate. The Fed cuts the interest rate like in March 2020, and the interest rate for the US dollars is very low. And there's this temptation phase for the emerging economies to, at this low interest rate, R is smaller than G, to go in this and generate this public convenience yield and benefit from that. And suddenly the US is increasing the interest rate again, or at some point it will increase the interest rate. But then it becomes this wobbly bubble phase. Suddenly it's not clear whether the emerging economy can sustain the high bond price it enjoyed during the temptation phase. So let me just look at this economy briefly, and that's how I think of the economy. So there's the emerging markets economy. It's consolidated balance sheet between the central bank and the fiscal authorities. Then there are the consolidated balance sheets of the emerging markets economy from the households, the firms, and the banks. And then there's, of course, some part of the US international balance sheet as well. But what's important is, well, how does consolidated government balance sheet look like? The government issues some bonds, it has government debt. But it holds some future tax claims and the present value of future tax claims, and it holds some dollar reserves. The central bank might hold some dollar reserves. And there's importantly this bubble term. Okay, there's this bubble term. Not everything is backed. Because of this bubble term, you can run this phenomenon as a bubble. So the government bonds are much more valuable relative to what the assets, the implicit assets of the government's balance sheets are on it. If you look at the balance sheets of the private sector, they hold the government bonds. They have also physical capital like machines, and they have to pay the future taxes. And they're also in dollar debt. Typically in this temptation phase, they also issue dollar debt because the dollar interest rate is very low. It's very attractive to go into dollar debt. It's less pronounced now than it was in earlier crisis, but it can also have this dollar debt there. That's on the US side here. And then there's a net worth of the private sector. Now, if now there's suddenly a sudden stop, what happens is, of course, the bubble term goes away. The bubble is bursting. the government debt now has to be backed with future taxes, so part of the value of the government debt is going away. So this is actually becoming much smaller. The private sector is suffering because they're holding this government debt, or whoever is holding this government debt. Now, instead of going into dollar debt, the private sector would like to hold now dollar treasuries as a safe asset. So what's happening is that there's a switch from holding the national bond as a safe asset, which you can do this precautionary savings and this retrading if somebody's idiosyncratic shocks and so forth. And of course, there will be fire sales of physical capital. Physical capital will be much smaller as well. Future taxes are not going away. And you have this sudden stop where there's actually this bubble bursts. So what's very natural in this setting, once you think in this setting of R versus G and this bubble evolving and think that the bubbles can burst, you can get it very naturally. You have sudden stops and there are dramatic shifts going on, very significant shifts in this setting. Now, how can you fix that with an integrated monetary policy framework? You can, do certain things in a sense that you can adjust your national monetary policy. You can do some FX interventions or some capital controls, or you can also do some macroprudential thing. And the question is, what tools are complements to each other? What tools are substitutes to each other? And of course, you can, as the US hikes interest rates, you can hike it too, in order to make sure that the safe asset status is maintained. But of course, it slows down the economy, and the G might go down because you hike the interest rate, and that kills you on the R versus G component as well. So there might be no way around it, except if you impose capital controls, then it doesn't allow the citizens in your country to use US Treasury as a safe asset. They have to stick with the national bond. So financial repression, capital controls, they actually would act as a stabilizer in there. But I'm not arguing for these type of measures. Now, let me just see what my time. So the US cut the interest rate. So there are many examples where, what did the US do? It cut the Fed, they cut the interest rate. The emerging and developing economies, they can prop up the fundamentals, they can make the fundamentals better, but they can also do certain measures to support the bubble component. So as I mentioned already, they might get capital controls in. They can also make sure as a central bank that their own national bond is working very smoothly when you have to retrade this national bond based on the shocks the citizens face, that the bid-ask spread is not getting too large or getting out of whack. And they can also intervene in the FX market to make sure that the bubble component stays stable, that the bursting is minimized. And of course, ex ante, they can also do something with capital controls. Rather than controlling the outflows, make sure that the inflows will be not so large, so the whole position, the debt level is not rising so much as we have heard from previous speakers. I'm running short on time, so I won't go much into the whole measures the Fed did in March and April last year, but I haven't talked much about the macroprudential aspects, and I would like to talk about the macroprudential aspects. But if I want to talk about macroprudential, I have to have a separate banking sector in the emerging or financial sector in the emerging market economies. So I have the consolidated balance sheet of households and firms, but I take the financial sector now out and have a separate sector in the financial sector. The banks and the financial sector, they hold also in government bonds. They account some, I call it here peso debt, because that's think of peso as the national currency. They account some loans to the firms and to the households. That's on the liability side of the household and the firms, but on the asset side of the banks. On the other hand, the banks, they issue some deposits, and the deposits are held by the households and by the firms on this other side as well. Just open up essentially consolidated private balance sheet into two balance sheets. And there's something interesting occurring now. Now, if there's a negative shock, what happens, the banks typically, which are good in diversifying idiosyncratic risk away, so everybody holds some of the deposits, and you hold the deposits also as a safe asset, as a citizen in your country, and suddenly the dollar debt appreciates. And what do the banks do? When the banks get under difficulties, then the banks will actually cut back on their balance sheets. And when they cut back on their balance sheets, they create less of the demand deposits, so there's fewer safe assets. Total money supply in times of crisis will go down. And it will also be the case that they give fewer loans So they will actually give fewer loans to the real sector as well. But they'll cut back on the creation of safe assets. The bond deposits will go down. And at that time, because in times of crisis, idiosyncratic risk will be higher, the demand for safe assets will go up. So typically when there's a lot of idiosyncratic risk, the likelihood that you lose your job is higher. You go in more precautionary savings and you want to save this in a safe asset. So if you put this together, the banks cut back on the supply of safe assets, the households increase the demand for safe assets. So if you're an advanced economy, like in the US, the consequence of that is the reduction in supply of safe asset, increase in demand of safe assets, this gives you deflation, okay? Now, but what's in an emerging economy is exactly what I described before. It's actually not deflation, it's inflation, it's the opposite, because people will run out of your country, they run into US Treasury and use US Treasury as a safe asset. Okay, so the growth rate of the economy shrinks. Because the growth rate of the economy shrinks, it pushes it below R, in your national economy, and actually they run out of it. So it's very different between the advanced economies or the emerging economies. Of course, this is an emerging economy with open, without capital control. So the citizens can run into the treasury as a safe asset. So there will be a twin crisis emerging in this country. So what's very crucial in this framework is that you see this stark difference between advanced economies and emerging economies. And that's what I'm afraid when the US hikes interest rates, that this will happen. And it might be in the interest of the US to keep the interest rate long for very low right now, and then as a consequence, might have to hike the interest rate much more down the road. And there might be negative repercussions for the emerging economies, which might be not internalized for the US policymakers. So that's where the macro-potential thing comes in. You should tighten already now. What's really important now, to be prepared for that, to make sure that when this happens, that you have enough reserves and you have enough buffers in the system, and you have enough resilience, and the more buffers you have, the more reserves you have, the more resilience you have in the system to make sure that this works out. So all of this framework essentially is very much, works, even though all exchange rates are flexible. It's very much what Alan Ray called the dilemma, not trilemma aspects, but it's just the theoretical foundations why this can be occurring. Let me skip that. I have proposed some potential global financial architecture bond structure, which might make the emerging economies less vulnerable to such spillovers of monetary policy. And I call this gloss piece, but this will involve some financial engineering in order to get this off the ground. So let me conclude, given I'm running already over time. There are some threats to resilience, and they come from spillovers from monetary policy. The emerging economies have their own national safe asset, and it has to, in order to be able, there's a temptation phase right now, because you can run this RF, there's an F missing, plus the risk premium is smaller than G. You can run this but this is actually only one equilibrium. There's another equilibrium where this whole thing breaks down. And in particular, it has to break down when suddenly the US interest rate is going up, and then the emerging economies will be sandwiched. And that's essentially the important component, and that makes the whole thing go away. And there's a policy mix that you can employ to make sure, but what's very important in advance to be aware of these things and build up buffers in order to have the resilience to avoid this crisis. And as I mentioned very briefly, there's other ways, more long-run structural ways you can address this, such that the fundamental problem is that the safe asset is provided asymmetrically. There's no shortage on safe assets. It's just the asymmetric supply of safe assets, primarily supplied by the advanced economies, very advanced economies, and they have the benefit in times of crisis, the interest rate goes down, while for the others, the interest rate in times of crisis goes up. And that makes the current architecture of the global financial system very much in disfavor of the emerging economies.
Thank you very much, Professor Brunnermeier. In terms of time management, we started with a little bit of deficit. I think I'm only accumulating further deficit here in terms of time management. So let me just directly go to the next panelist discussions. Dr. Marco Bassetto, please.
Can you see my slides?
Yeah.
Good. I will mostly discuss the remarks that Professor Brunnermeier just gave, and I want to focus particularly on this question of safe assets and the challenges that emerge in a world in which government debt is suddenly much higher than it was. I should mention that everything that I say tonight, well, tonight for me, this morning for you, represents the views of myself only and not those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So the first, I want to motivate what I'm going to say by looking at a few pictures. So this is U.S. federal debt held by the public as a percentage of U.S. GDP. You look at down here, this is roughly 83. Those are the Reagan deficits. And at the time, they were perceived as very worrisome. Sargent and Wallace wrote a paper that was cited in Sargent's Nobel Prize award about unpleasant monetary arithmetic, the danger that monetary financing will be needed to cover deficits. Well, that was that deficit. Then we had the financial crisis, and we've had the COVID crisis. So they're completely unprecedented except for World War II. This is coming down, but it's misleading because this is debt subtraction of GDP, and of course GDP has been recovering fast, but the economy is not going to go on and recover, grow at the same pace as it has in the last few quarters, just because it was coming off of a disastrous year. So there's a very unprecedented increase in U.S. debt. This is not just the United States. Many countries have a similar picture. I have to say I checked Korea. Korea has been much more disciplined than others. So they may be more resilient in that dimension. Now, the flip side that has been widely discussed, including at this conference, is the interest rates have been very low. And so here I'm plotting the 10-year constant maturity treasury rate. I want to make sure that you notice that I'm starting here in 1995 rather than going further back in time. The reason is I want to focus on a period in which inflation has been pretty stable. Yes, it has been trending slightly downward even in these 25 years, but not that much. And yet interest rates were above 7% at the beginning, and they're now barely above 1%. So that's sort of compensates. You have a lot of debt, but at the same time, of course, the interest rate has been coming down. So the cost of servicing that debt has been coming down a lot, which makes that undoubtedly more sustainable. Now, the third picture that I want to introduce is this one, which comes from a paper by Arvind Krishnamurthy and Annette Wiesing-Jorgensen that was published in the Journal of Political Economy. It's one of the best attempts that we have in trying to look at historical data and figure out the relationship between what Markus mentioned as the convenience yield and the quantity of debt outstanding. So you might think, there's a value of having this safe asset out there. It's undeniable. You look at the United States, Germany, but also certainly United Kingdom, Japan, and so on. There seems to be something special about government debt, at least of these advanced economies, that allows them to borrow rates that are below interest rates charged to private corporations. For instance, here we're looking at AAA treasury spreads. So these are very safe companies in the United States. And what the picture shows us is that essentially this convenience yield gets to a very low level. Well, in the past it got to a very low level, roughly at 60% debt to GDP. So remember, now we're over 100% of GDP. And so the key question that we're left with is what determines the current low rates at really high levels of debt. So we have these theories. I think Markus, with his co-authors, produced many insightful papers about this. I have a little bit of work on that myself too, but I think that there's this value of having government debt, but how much remains an open question. And then the second question that comes directly after that is, now that we've accumulated all this debt and apparently interest rates are still very, very low, is this something special about the COVID crisis? Or is it something that will last for the longer run? And that, it would be easier to know if we had a clear vision of why this is the case or it's not the case. I mean, certainly, during the COVID crisis, there was some saving that came just from the fact that many of the things that we used to do, we couldn't do anymore. So, you couldn't go to a restaurant and have a nice meal at a restaurant because many restaurants were closed. Now that's no longer the case in the United States, but still, people are somewhat worried about being very crowded places, so probably restaurants are not as crowded as they were before. And same, for vacations and things of that type. Once the COVID crisis hopefully finally will be over, will we go back to something more normal? So will people try to spend all this government debt or not? That's an important question. And if not, then the question is, what is the new cessation point? So here in Krishnamurti, Wissing Jorgensen, we say, well, 60% is where essentially all these convenience yields go away. Well, 100%, so maybe now this demand has shifted, but where is that point? And will we find out in time? So one of the challenges are, there's politicians have been become a little bit used to the fact that you can run big deficits and interest rates don't move. What if they move suddenly rather than giving early warnings? So those are the things that we need, I think, to think about the future. So the last remark that I wanna finish is so there's been quite a bit of discussion, starting with Olivier Blanchard's presidential address at the American Economic Association, but not only, about the fact that when the interest rate on government debt is below the growth rate of the economy, the cost of issuing extra debt might be very low to non-existent. So maybe that is even a free lunch. That's certainly not what Professor Blanchard mentioned. He was very careful in and measured in stating his points. But there was a sense that the cost of issuing extra debt might not be that high. So what I want to think is that the relevant metric to think about where issuing extra debt is going to lead to tighter policy in the future is not R less than G, not average interest rate, but marginal interest rate less than G. And so let me clarify what I mean by that. So the point is, when so suppose we issue some extra debt today, we have two things. One is we have some extra debt out there that we'll have to pay back. But to the extent that R is less than G, we don't really need to pay that debt back after all, because we can leave it out there, and the growth rate of the economy will take care of slowly making it vanish. The problem is we're also raising potentially the interest rate on all of the existing debt. And that's a part that is a little more challenging because we haven't seen that happening yet. But most economists think that at some point that will go on, and we don't know whether it's going to be abrupt or gradual. But to the extent they're issuing more debt now, raises the interest rate on all the debt that we've already issued, then the appropriate measure of the cost is the additional debt that we're issuing plus all this additional interest that will be due on that debt. And when you do the sum of the two, it might very well be the case that the marginal interest rate is above the growth rate of the economy. And so in the future, you'll have to tighten your belt and at least run smaller primary surpluses. Certainly, as long as R is less than G, you can keep running primary deficits and have a stable debt, but you're going to have to run smaller primary deficits. And that's something that might require potentially painful fiscal adjustments. And it's something that, as policymakers, we should start worrying about now, and certainly as economists too.
Thank you very much.
And I think I'm going to stop here.
Yeah, thank you very much, Dr. Bassetto. And next is Dr. Adrian, please.
Yeah, thanks so much. And thanks for the Ministry of Economy and Finance for organizing this wonderful conference. So I will give my current thinking about global financial stability. So let me start by asking what the economic data and market pricing is telling us about global financial stability at this very moment. So the first half of 2021 propelled markets due to a sense of optimism on the back of COVID-19 vaccines that were rolled out around the world. However, over the summer, the rebound in the global economy faded as the Delta variant spiked in countries around the world. Nevertheless, US equity markets saw new record highs, while fixed income markets traded with a more cautious tone. The US 10-year yield declined sharply by about 50 basis points since the spring. The decline in global long-term yields was almost entirely driven by a fall in real yields at longer horizons, which we see as consistent with investor concerns about the global recovery, longer-term growth prospects, and virus mutations. In fact, economic activity data based on surprise indices, so when economic news is announced and you compare what are investor expectations relative to the data that is actually released, those surprise indices are no longer better than expected in most countries, and in particular in the US and the Euro area. Not surprisingly, against this backdrop, central bank communication has been very cautious about any possible reductions in asset purchases or normalizations of accommodative policies in advanced economies. While most investors still anticipate recent consumer price pressures to be temporary, concerns about upside risks to inflation have emerged, especially in the United States. In fact, investor flows into inflation-protected funds mirror those concerns. So those flows into inflation-protected funds have been at record highs. We also observe a shift in market-implied inflation distributions to be skewed towards higher inflation. Investors have highlighted the possibility that supply chain disruptions and shortages of labor and materials may be more persistent than currently anticipated, feeding into wage dynamics and eventually inflation expectations. Having said that, a return to low growth, low rates, and low inflation over the medium term remains the modal outcome priced in markets. We also see low volatility returning across markets. In line with low volatility, credit spreads have continued to narrow. The low credit spreads are fueling a boom in credit, including in public and private credit markets, as well as in loan markets. Housing prices have risen rapidly in many countries, reflecting both shifting household preferences as well as policy support, longer-term low yields, and easy financial conditions more broadly. So we certainly detect, that housing valuations are stretched in many economies, and that takes me to my second topic today, which is our current assessment of financial stability. Financial vulnerabilities remain elevated in many sectors. The highly accommodative financial conditions on the back of still highly accommodative policies create significant stability concerns and put future growth at risk. Our research shows that equity price misalignments relative to fundamentals are elevated in most markets. And that's, of course, very much aligned with previous speakers. Both Jeff and Markus have talked about the stretched valuations. We see that particularly in equity markets and in certain segments of the equity market in particular, and in housing markets. Risks are also rising at some non-bank financial institutions as they are reaching for yield to meet nominal return targets. For example, life insurance companies still face elevated asset liability duration mismatches in many jurisdictions. Seeking to enhance their return on investment, life insurers in many countries have increased the share of lower quality bonds. In the current environment of persistently low interest rates and ample liquidity, greater use of financial leverage to boost returns could lead to volatility in markets. Banks have played a crucial role in supporting the flow of credit to the economy during the pandemic. But bank loan underwriting standards remain restrictive in many countries. According to bank loan officer surveys, this posture is expected to persist, with risks to the credit outlook as the main constraint on loan growth. A possible slowdown in international bank lending may pose additional downside risks to many emerging market economies. Let me add some specific comments on emerging markets. The ongoing global recovery and robust global risk appetite has improved the outlook for capital flows to emerging markets. Nevertheless, emerging and frontier markets as well continue to face large financing needs. Local currency government bond yields remain elevated in many countries despite the recent declines in US Treasury yields. Several emerging markets have tightened monetary policy substantially after inflation surprised to the upside this year. Nevertheless, monetary conditions are still broadly accommodative with deeply negative real rates. But there's a risk that real rates may rise significantly in coming years, and of course, Marco just talked about that. A sudden change in the stance of monetary policy of advanced economies may result in a sharp tightening of financial conditions, adversely affecting capital flows and exacerbating pressures in countries facing debt sustainability concerns, especially in frontier markets. Let me talk briefly about crypto markets. The rapid growth in the crypto ecosystem presents new opportunities and new challenges. Crypto asset exchanges pose several operational and financial integrity risks through their cross-border operations. Investor protection risks are substantial for crypto assets and decentralized finance. For example, stablecoins have generally poor disclosures and can be subject to runs if their reserves come into questions. And we have seen one such stablecoin being literally run on. In emerging markets, the advent of crypto assets and stablecoins may be accelerating dollarization and eroding the effectiveness of existing exchange restrictions and capital control management measures. Increased trading of crypto assets by emerging market users can potentially lead to destabilizing capital flows. Of course, Korea was one of the first countries to address those issues actively. So that takes me to my last set of remarks, which are the policy conclusions. Monetary and fiscal policy support remains essential to support the ongoing recovery as substantial downside risks to the economic outlook persist. Central banks should provide clear guidance about the future policy stance to prevent an abrupt tightening of financial conditions. If price pressures turn out to be more persistent than currently expected, monetary authorities should act to prevent the de-anchoring of inflation expectations. And that's what we have seen in a number of emerging markets where central banks have acted actively against the rise of inflation. Fiscal policy should continue to support both firms and the most vulnerable individuals. Given fiscal space, additional measures should be tailored and targeted in respect to country-specific characteristics and needs. A prolonged period of extremely easy financial conditions, while needed to support the global recovery, may result in stretched asset valuations and fuel financial vulnerabilities that, left unchecked, may put growth at risk in the medium term. So policymakers still face a challenging intertemporal trade-off, maintaining near-term support on the one hand for the global economy, while preventing unintended consequences in the medium term to financial stability. Policymakers should take early action and tighten selected macroprudential policy tools to tackle pockets of elevated vulnerabilities while avoiding a broad tightening of financial conditions. As emerging markets remain exposed to the risk of a sudden tightening of external financial conditions, they should certainly leverage the historic general SDR allocation and complement that by rebuilding buffers as appropriate. Finally, structural reforms to insulate economies from the adverse impact of capital flow reversals and sudden increases in funding costs also remain key priorities. Let me stop here. Thank you.
Thank you very much, Dr. Adrian. Our final discussant or panelist is going to be Professor Viral Acharya. I would expect your authoritative comment as a final speaker.
Great. Thank you so much to the organizers for inviting me. I want to make 3 points. And as I make the final point, I'll try and bring the presentations of Dr. Kose and Dr. Brunnermeier together, hopefully. First, I wanted to point out that the risks to emerging markets, in my assessment, are very substantial at present. The primary rationale for this is that, in my view, the Federal Reserve of the United States is behind the curve in responding to inflation. The reason is simple. Unlike past episodes of recessions, at least the recent ones, the United States government has spent or is planning to spend more than what was spent after the New Deal in 1933. This means that the responsibility on the Federal Reserve to provide the stimulus is substantially reduced. And in my view, the inflation that we are seeing, in fact, I think that what's in the headline numbers is actually lower than the rate of increase of my consumption bundle for sure around me. I think inflation seems pretty much around. And I think, I don't know if you've been following the whole shipping industry costs, but I think today there is a statement by the CEO of Maersk, I believe, that he basically says that unless consumers reduce their demand, there is no way for us to actually meet their demand without actually jacking up the shipping costs. Now, while that may or may not necessarily be risks to the United States macroeconomy, as Dr. Brunnermeier explained, if there is a very rapid tightening by the US Federal Reserve or normalization of its asset purchases, both of which I think are perhaps likely if inflation turns out to be persistent, as is my fear based on, frankly, just my experience of inflation around me rather than looking at any statistical data or anything like that. Then I think emerging markets could be in quite a bit of a soup. And there are two primary reasons for this. One is that historically, when things like taper tantrum hit emerging markets, they were actually growing quite fast after the global financial crisis. Right now, the problem is that emerging markets have actually contracted over the last year. So this time around, the Fed is likely to be tightening at a time when emerging markets actually need more capital flows in order to support that growth. And the second reason is that the emerging markets are not also immune to the inflation that is being experienced globally. They are themselves actually recording above target inflation rates in most countries. And so I think it sort of seems a very poor coincidence where the US is growing very fast, the emerging markets are not. They are yet to grow very fast after the pandemic, but both of them are actually racing ahead on inflation, regardless of their growth trajectories. And I think this is a serious problem in my view. So fun, I just wanted to highlight that emerging markets should worry about this risk of Fed having to tighten rapidly in the next year or 18 months quite seriously. Second, I'm of the view that emerging markets that are already tightening, as Dr. Adrian mentioned, may actually be doing the more prudent thing compared to those who are not yet responding to that. The reason is that it's going to be much harder for the domestic economy to face a US tightening and a domestic interest rate tightening at the same time. In terms of spreading the growth impulses over a period of time, rather than experiencing rapid growth and then rapid contraction, a scenario in which the domestic central bank is in a position and has monetary space to accommodate when the Federal Reserve tightens is a far better situation than one in which both central banks are actually tightening for the domestic economy at the same time. And there's one added benefit that I want to highlight here, which is that if an emerging market central bank has tightened when its inflationary impulses are strong, it has actually built some credibility of being willing to take the growth sacrifice. And this actually comes in very handy when it is accommodating at a time when the Federal Reserve is tightening. Put simply, if you have not built credibility by making some growth sacrifice when your inflation impulses are high, it's very hard when Federal Reserve tightens and capital outflows are losing you to say, oh, listen, I'm an inflation targeting central bank, because, that's just cheap talk. You have to have had some credibility built into the expectations of the markets through your prior actions. We faced something like this in 2018 when I was at the Reserve Bank of India. We had tightened, much to everyone's dismay, in response to inflationary impulses. But then the Iran sanctions and the oil prices were skyrocketing. And then the expectation was that we would actually keep tightening now as an interest rate defense of the currency. We did not want to do that. We actually let the currency absorb the pressure at that time. And in my view, we could afford to do this because we had actually built credibility as an inflation targeting central bank. So I think emerging market central banks need to use the time provided by the Fed as a way to persist with their inflation credibility, because if they don't, they will not have much space to do anything other than tighten very dramatically along with the Fed when the time comes. The last point I want to make is to then bring together Dr. Brunnermeier's concerns about this sorts of sudden stops playing out for emerging markets, especially on their safe assets, with what structural policies they can adopt. My sense is that, from what I experienced as a central banker in India, is that even though the sudden stop in its language sounds very sudden, it seems like something that's happening at a point of time, in reality, it does play out over a period of 6 to 9 months. And there are actually many action policy points available to emerging markets besides what the central bank can do. The central bank's policy points are usually linked to interest rates, and in most countries, they are also linked to capital controls and possibly the reserve policy or the exchange rate interventions to stabilize the currency. If the central bank is the only one fighting this war when the capital outflows are happening and the Federal Reserve is tightening either on target or faster than expected, then the central bank unfortunately becomes a bit overloaded in this activity. Because you ultimately have to understand that an emerging market is an emerging market because it is not actually growing. It's growing fast, but it is not where its potential output could have been. And why is it not there? It's not there because it typically lacks financial liberalization. It's traditional businesses, industrial families. They want to prevent control of these enterprises by foreign capital. They are very happy to take on foreign portfolio inflows, but they might be far more reluctant to take on foreign direct investments. So very often you will find that many emerging markets who should really be liberalizing their equity for foreign direct investment, which brings in not just capital, but also brings in professional expertise, it brings in productive efficiency into the economy. These are actually very, very tight. In my view, these are the biggest capital controls that are in place in emerging markets, which is that they don't allow FDI in areas where they can really potentially unlock a great deal of value. And of course, emerging markets, governments are also sometimes very myopic in their policies. They don't have quality institutions designed to control their fiscal imbalances. And as a result, they are very often not investing in long-term growth. They are not investing as much in infrastructure, health, and education. They are very often focused on short-term subsidies, or what in emerging market parlance is called as revenue expenditures rather than capital expenditures. So in my view, emerging markets can, on the one hand, prepare financially for the Fed shock that is likely to arise. But even more importantly, they need to think about liberalizing their capital flows, but on the FDI front, they need illiquid equity flows to come into their economy. and they really need to invest in the long term of their economies as we speak, because that is what would actually prevent the strength of the capital outflows that they are likely to see. And so I think just to bridge what Dr. Brunnermeier and Dr. Kose mentioned, emerging markets are risk at both of low output and a financial Armageddon through the Fed tightening. And the way to fight it would be to improve the economy's capital flows, which is to bring in FDI equity wherever possible. And second, to invest in structural reforms and infrastructure. I'll stop. Thank you.
All right, thank you very much. I think I didn't do a good job so far. I got the warning signal from the conference organizer for being too late. So they want me to skip Q&A session. But let me just ask you one final question before I conclude. We heard everything bubble story from the Jeff Frankel's presentation and self-fulfilling bubble story from Professor Brunnermeier's presentation. And so many people are worried about the financial instability possibly coming up when the U.S. monetary policy is normalized, especially for developing or emerging countries. But Dr. Bassetto showed us a long-term and chronic downward trend of the interest rate everywhere, especially, including U.S. economy as well. So when we normalize U.S. monetary policy, where do you see the next so-called normal policy rate? I mean, all these bubble stories and too much death stories functions of next phase interest rate, right? So can I ask you, Dr. Bassetto, about where you see as the next normal policy rate?
Well, you probably should ask somebody else, because I would be one of the most reluctant people to speak, given that I'm not speaking for the Fed. I think we'll need to find out where what is needed to satisfy the Fed's mandate, I don't have a crystal ball, so I'm not sure where that's going to go. I'll let Tobias take the question.
All right. In the previous phase of the policy normalization process, many people expected somewhere around 3% as a normal U.S. Policy rate, but they could not reach there actually. So, what about the next one? Dr. Adrian, you have any idea?
Yeah, absolutely. So let me make 3 points. So the first one is that this decline in longer-term interest rates that Dr. Bassetto showed is really one that is associated with declining real yields. And in particular, when you look at the term structure of real yields, it's far in the future forwards that keep declining, okay? So what central bankers often look at are the five-year forward real yields. And so this is the closest thing to what you have from markets, which is a kind of neutral real yield, right? Because 5 years into the future, 5 years, from 5 years to 10 years into the future, we think that monetary policy is roughly neutral on average. And so those real yields keep declining. So that is a very, very important backdrop for monetary policy. because it's a huge constraint, right? So you normalize relative to a neutral yield, which has kept declining, and it has kept declining throughout the COVID crisis. Secondly, about inflation. So I would like to distinguish, and I made these points in my remarks, but I just want to reiterate them. The modal path implied by markets and by analysts. You can look very broadly at analysts. For example, the Federal Reserve Bank of New York has a very nice summary of inflation expectations, both by households and by professional forecasters. The modal path is one where inflation is temporarily high, but then is coming down. And so that, of course, is very important for the Federal Reserve's new average inflation targeting framework, which basically says that inflation should be moderately above target, and if that is long enough, at that point there will be a tightening. And so the expectation is that there is a moderate increase, but that will be coming down. As a result, the market implied lift-off date is fairly far into the future, sometime around early 2023. Right? That is what the market expects. Now, of course, there are lots of risks around that. And that's my third point. And that's the point I made earlier. The distribution, the market implied distribution of inflation, right? When you look at options on inflation, the market implied distribution has a lot of skew to the upside. So the market is pricing in quite a lot of risk that inflation might be higher than what is priced in terms of the modal outcome. And at that point, this is when those fears about another taper tantrum might be realizing. And, this is my way of looking at what Dr. Acharya and Dr. Brunnermeier were referring to when they were referring to the risks to emerging markets from capital outflows associated with unexpectedly early and sharp tightening of monetary policy in advanced economies.
All right, thank you very much. I wish I could give you more time, but our master of ceremony is standing by for time now. So let me conclude with this. I think our discussions in this session must have been very productive in deepening our understanding about the capital flows and what could be the next potential dangers when the global monetary policy is unwinding. As a policymaker or financial investors, we probably have to should not exaggerate the potential danger, but we should always keep alert to these possibilities of financial risks. For that purpose, I think it has been very productive, and I really appreciate all of you for sharing your insight with us, including Korean audience here. Thank you very much.
Thank you. Thank you very much. I'm sorry I'm standing earlier than you expected. But thank you very much, the moderator, for guiding us with the session 1. And all panelists, thank you very much for joining us in real time overseas. Thank you very much once again.